In this video, we will be looking at one particular adjustment that is to be made while preparing cash flow statements as per Indian Accounting Standard 7. And that is foreign exchange gains and losses that relate to cash and cash equivalents. So let's just look at para 28 first. So as per para 28 of Indian Accounting Standard 7, unrealized gains and losses from foreign currency exchange rates are not cash flows. We know this, it's quite obvious. So suppose you have a foreign currency debtor. So your customer is say from the US. You have sold to the customer, you have billed in dollars, and at the end of the reporting period, the customer has not yet paid us. So when we report the foreign currency customer at the exchange rate at the end of the reporting period, there may be some exchange difference, and that difference may be gain or loss. So obviously that is not a cash flow. So that we know. However, the effect of exchange rate changes on cash and cash equivalents held or due in a foreign currency is reported in the statement of cash flows in order to reconcile cash and cash equivalents at the beginning and at the end of the period. This is what we are going to discuss in this video. So normally foreign exchange gain or loss relating to the other items, relating to working capital or relating to investing or financing, the treatment is the same as any other expense or income, right? And we have discussed this in the previous video. If you would like, you can go through that video. The link is shared in the description. So in that video, we saw the logic of the indirect method. So that holds good for normal foreign currency, foreign exchange gains and losses. What we are discussing in this video is the specific treatment of foreign exchange gains or losses that relate to cash and cash equivalents, right? So what is the need for this? Let's delve into this video. So let's say we have bank account, we have opening balance say 20 lakhs, we have cash sales of say 12 lakhs, and for the sake of simplicity we will assume there are no other transactions. We have opening balance and we have sold. Okay, last year's we had some stock and we have sold that on cash. So our closing bank balance should be 32 lakhs. Now how would this appear in the direct method? We will have cash flow from operating activities, cash received from customers, that is this 12 lakhs, and then let's assume that there are no other transactions. So this will be 12 lakhs. Then cash and cash equivalents at the beginning of the period, that will be this 20 lakhs, and then cash and cash equivalents at the end of the period, that will be 32 lakhs. Now suppose this amount of 32 lakhs is in foreign currency, right? So any amount in foreign currency, when you report it at the end of the reporting period, you have to use that particular exchange rate. So when we report it at the end of the year, let's say that this amount is 30 lakhs instead of 32 lakhs. So we have some money in the bank that is in foreign currency and we restate it at 30 lakhs at the end of the year. We report it at 30 lakhs. So how would we account for the difference as per Ind AS 21? That would be a Forex loss of 2 lakhs. So this, remember, this what we are discussing here is foreign exchange gain or loss relating to what? Cash and cash equivalents. Now let's see how we should prepare the cash flow statement under direct method when we have this Forex loss. So we would start with cash flow from operating activities, cash received from customers, that is this 12 lakh. So there are no other transactions. This is our net cash flow. cash and cash equivalents at the beginning of the period, what would we write? We would write this 20 lakhs. Now, when we add these two, we get what? We get cash and cash equivalents at the end of the period. We are supposed to get 32 lakhs, but because this cash is in foreign currency, we have a forex loss. So, the actual balance of cash and cash equivalents as per the balance sheet is 30 lakhs. So, cash and cash equivalents at the end of the period as per the balance sheet is 30 lakhs. How do we reconcile this? We show forex loss as an item of reconciliation. So, forex loss 2 lakhs and we get 30 lakhs. This is what para 28 is talking about. So, I hope now it is clear. So, we need to report the effect of exchange rate changes on cash and cash equivalents that are held or due in foreign currency in the cash flow statement to reconcile cash and cash equivalents at the beginning and end of the period. So, unless we report it, so it is not a cash flow, but if we do not show that, our cash flow statement, the value as per the cash flow statement and as per the balance sheet will not match. That is why we report it. It is like bank reconciliation, right? So, we are reporting the forex loss in order to reconcile the cash and cash equivalents that should have existed and the actual cash and cash equivalents as per the balance sheet after taking into account the impact of foreign exchange changes. Now, the next interesting point is how would we do this as per the indirect method? Now, as per direct and indirect method, the net result should be the same. Net increase in cash and cash equivalents supposed to be 12 lakhs. So, under indirect method, instead of writing this 12 lakhs as it is, we are going to write it indirectly, right? So, in indirect method, we start with the P&L values. So, we have P&L. So, for the sake of understanding, we are assuming that cash sales 12 lakhs and forex loss are the only items in P&L. So, that being the case, what is our net profit? Our net profit is 10 lakh. And we in indirect method, we start with this 10 lakh. Cash flow from operating activities will be profit 10 lakhs. So, when we write this 10 lakhs here and then do not do anything, we just continue that 10 lakhs. Will the cash flow statement tally? So, we start with 10 lakhs assuming no other items. Cash and cash equivalents at the beginning of the period is 20 lakh. So, 10 plus 20, 30 lakh, we have got this. And cash and cash equivalents at the end of the period as per balance sheet 30 lakh. There is no need for any reconciliation. So, the question now is, can this be done, right? So, the answer is no. Why? Because net cash from operating activities is not 10 lakhs. It is what? It is 12 lakhs, right? So, just because not doing anything will make the cash flow statement tally, that does not mean it is correct, okay? So, this 10 lakh is not actually correct. We need to show what? We need to show 12 lakhs. 12 lakhs is the correct net cash from operating activities. So, in order to show that 12 lakhs, we start with this profit, we need 12 lakhs now. So, what are we going to do? We are going to add back this forex loss. So, we are going to add back forex loss of 2 lakhs so that we get the correct net increase in, or rather net cash from operating activities. So, the point is, in indirect method, our object is not just to tally the cash flow statement. Our object is to get this net cash from operating activities indirectly. Ultimately, we want 12 lakhs here in the cash flow statement. How to get this 12 lakhs indirectly? When we start from 10 lakhs, we need to add back this 2 lakhs, right? So you need to think out of the box for Forex gain or loss that relates to cash and cash equivalents. Normally we don't make any adjustments relating to cash and cash equivalents, right? But this is a unique adjustment. Fine. So in indirect method, what we need to do is we need to add back the loss or we need to subtract the gain, if any. So we get net cash from operating activities. This is the correct net cash from operating activities. When we proceed further, cash and cash equivalents at the beginning of the period is 20 lakhs. What should have been the cash and cash equivalents at the end of the period? That is 32 lakhs. But cash and cash equivalents as per balance sheet is 30 lakhs. So what we do? We show this Forex loss as an item of reconciliation. So minus Forex loss 2 lakhs, and that will give us cash and cash equivalents at the end of the period as per the balance sheet. So let's quickly summarize what we need to do under the direct method. In the direct method, we will simply show cash received from customers and all other cash flows directly, and we show Forex gain or loss as an item of reconciliation. That is all we need to do in direct method. In indirect method, we won't get this 12 lakhs. Instead, we will get 10 lakhs. So the rest of the items are the same. So if you compare in direct method, see all these values are the same: 12, 20, 32, minus 2 and 30. In indirect method also, from here everything is same. The starting point, we start with profit, we add back the Forex loss or deduct the Forex gain. The rest are all the same as per the direct method. So let's quickly summarize foreign exchange gains and losses with respect to cash and cash equivalents. So if it is Forex loss, in direct method, we just show it as a deduction in reconciliation, that is at the end of the cash flow statement. In indirect method, as part of the cash flow statement, we first make a P&L adjustment. We add it and then we show it as a deduction in reconciliation, that is at the end of the cash flow statement. Forex gain treatment is reverse. Direct method, we just show as an addition in reconciliation. That means at the end of the cash flow statement. And in indirect method, we first deduct it to get operating profit and then show as addition in reconciliation.